Inflation is still at its highest level in 40 years. Quantitative tightening has started and energy costs might double. This is the perfect time for everyone to double down on investing. But according to Fidelity, investors are doing the exact opposite of what they're supposed to do. Some 71% of retirement savers tell Fidelity investments that they are worried about how inflation will affect their savings and their ability to retire. And maybe more ominously, about a third, about 31%, say they don't know how to make sure their savings will keep up. Results come in the new 2022 State of Retirement Planning Report from the fund management and 401k giant. Among the other alarming news in the survey, 21% of younger savers, meaning those aged 18 to 35, told Fidelity they cashed out their 401ks last year when they quit their job. And 45% of those younger people say there's no point of saving for retirement until things get back to normal. Here's the thing. This is the new normal. And even if we completely recover from the economic devastation of COVID, something else will come up. What you should be doing is actually understanding how inflation is going to affect your future. Because you can't always trust the number. While the overall official rate is 8.5%, the government's own data shows double-digit rises in the past year in meat, poultry, fish, eggs, and milk, fresh fruit and vegetables, and things like cars and major household appliances. Oh, and of course, anything related to energy. Gasoline prices still within the $5 range. But the main thing keeping the official inflation rate down to just 7.9% instead of what other experts say to be above 13% is that more than half of the entire calculation is based on the cost of housing. And the government number crunchers think that those costs have risen by just 4.5% a year in the past 12 months. Remember that inflation is an uninsured risk, or in the parlance of Wall Street, they have an unhedged exposure. Retirement portfolios consist of stocks and bonds. The theory is that supposedly one will do well, then the other does badly. But during periods of high inflation, both can do badly at the same time. Check the high inflation rate of the 1970s. From 1967 to 1981, an investment in the S&P 500 had lost almost a quarter of its purchasing power, and investments in a 10-year U.S. Treasury bonds had lost a third. It's hard to overstate the financial damage that caused. Savers didn't just lose money in real times, they also lost time. Someone expecting an average stock market return of 5% a year above inflation would have expected to double their money in real purchasing power terms during those 14 years, so they ended up with barely a third of what they had expected. So look into alternative assets, gold, crypto, and others. Consult your financial advisor and do your own research. Interest rates will keep going up. Inflation will remain high. Your own future is always at risk. If you decide that having physical possession of your gold is better, or owning actual gold in your IRA is better, Noble Gold Investments can help you. Noble Gold Investments offers concierge services for your precious metal investments. It will take you no more than 5 minutes to open an account, and after that, Noble Gold will do most of the heavy lifting for you. All you need to do is wait for our emails and calls. So call Noble Gold Investments at 877-646-5347 to talk to one of our specialists. No pressure. We'll just be here to answer your questions. Or you can go to www.noblegoldinvestments.com.